Michelle Schneider, Managing Director at Market Gauge Group. Mish, nice to see you. Happy Friday. Where do you want to start? There's a whole laundry list of options here.
Well, I thought a lot about this. What could I bring to the table that would be different than all the other talking points? And so I think we have a few things that we can talk about, John. Number one is, in the terms of the entire meltdown of the market, if you look at what we always like to look at the most, which are the inside sectors of the U.S. economy, which would be the Russell 2000, the retail, and also the transportation, all of those prices fell to an 80-month moving average and held. Why is that significant? Because that 80-month moving average really measures about a 6-year business cycle. So there are two ways we have to look at the market right now. Either we actually tested the low of a long-term bullish business cycle, and even though we won't see much in the way of growth, it doesn't necessarily mean a deep recession, as many are calling for. Or two, in the coming days and weeks, if we can't hold this rally and we start to go lower and break that 80-month cycle, then I think we have more discussion about recession, and we can take it from there, and obviously more pain in the market. So that's something really important, rather than try to guess about what's going to happen. We already know the Fed's not going to pivot. Inflation is high. So that's one thing. And the other thing that I think is really important is to watch the bond market. And not just the 2-year and the 10-year. We know that the yield curve is inverted to levels not seen to 1980, but the long bond, because the long bond, which obviously has also gotten killed, the TLTs, is now hit its support from 2011. And if that can stabilize on the long bond basis, not only will that give some breathing room to some sectors of the market, but it also could be a sign of more flight to safety back to those long bonds, and more of a clue of Fed, how far they're going to go from going forward. So we've got our eyes there in terms of the actual equities market.
Really helpful guide on some levels to watch, certainly some technical trends, which everybody's been talking about. And as you talk about, and we talked about before, I mean, when you're in a down market, you can have some big up days to go along with those big down days. I wonder, though, this has come up a few times recently, Mish, just the fact that you could feel that energy before the inflation data yesterday. Investors, once again, were ready to see something that suggested a peak in prices. And then it didn't happen, and subsequently we saw the sell-off, but then obviously people came back. Just the idea that people are looking to make money or save for their retirement and have a place to put that whatever they've got back on the table. Should we not be discounting that, even though there's, a course of people that keep saying don't fight the Fed?
Well, there are certain areas that are starting to interest us. Stocks that have gone down a lot that look like they could be worth a nibble. I mean, we have a list. We're still very heavy in cash, but we don't really want to get overly involved in the market in terms of equities until, like I said, we see further proof that as we continue to go through this year and we get through a holiday season and we get through another Fed meeting, we don't feel that some aspects of inflation may have peaked, of course, but we still are very concerned about food prices. So there's 2 points of your question here, so I'm going to answer the first part of the question first. Yeah, do I think that things like Paramount, which is streaming and deals with CBS, at these levels, at between $18 and $19, you wonder how much cheaper could that get? Cheesecake Factory, which is part of the restaurant business, which right now is still very robust. I actually posted an article today that New York's restaurant scene is already booked out through the holidays. So maybe some of these lower price chain restaurants that aren't quite down to Burger King, McDonald's level, like Cheesecake, could be good at around this $30 level. So there's stuff out there for sure. We're looking at companies like J.B. Hunt as we're getting into the season here of more deliveries. But we're still looking at this food inflation concern. And here's my other little secret formula, and I'm not sure if you and I have talked about this before, but sugar futures. So while everything else has been super volatile, corn, soybeans, wheat, oil, energy prices in general, sugar has been really, really firm. And it's interesting for 2 reasons. Number one, is that sugar is in everything, obviously, number one. And number two is that sugar is often something that can be measured in terms of social unrest, and right now we've been seeing that in some other countries. I'm not necessarily suggesting we're going to have it here, but if sugar prices start to fly, it was an early indicator in the 70s, and we're watching it very carefully here. If that begins to roll over, then I would be more in the camp of stagflation, not necessarily hyperinflation, and not necessarily deep recession. I don't think we have enough evidence yet to really say definitively bottom, buy right now in the market.